Good morning, students. Let us continue with the topics of derivatives. First of all, let us recap what we did in the previous session, and then we will start from where we left. So in the previous session, we started with a different type of derivative called options. So we studied, first of all, the basic definitions of both the options. First one was the call option, and second one was the put option. So what does call option essentially meant is, a call option is a right contract option which gives the holder a right but not an obligation to buy. So this was very critical. We have to understand that it gives the holder the right to buy the underlying asset, which is the specific underlying asset at a specified price. And for the time limit, we said there can be two things. It can be on an agreed date, which is a fixed agreed date, or up to an agreed date. This is called as call option because it gives the holder the right to buy on a future date. That is what the essence is. On the other hand, put option gives the right to put. That means right to sell the underlying asset again on a specified date or up to a specified date. Then we discussed about the American option and European option. In American option, we said that if the contract gives you a right to exercise this option at any given of at any time up to the specified date, then that is called as an American option. And if the contract says that it has to be exercised only on a specified date, then it is a European option. Okay. Generally, in India, we deal in European options. Now, then we studied that who are the parties to the options. We said that parties to the options are definitely different to what are the parties of underlying asset, because here the sale and purchase is happening of the right, not of the underlying asset itself. Correct? So the right to buy is sold and purchased. Similarly, the right to sell in case of a put is sold and purchased. So what we said is the buyer for a right to buy is the buyer of right and the seller is the seller of right, because they are selling and buying the rights, okay, not the underlying asset itself. And hence we said that this buyer has not to be confused with the buyer of underlying, although while going on the expiry, correct, on expiration or up to the date of expiration, he will buy the underlying asset because he's buying the right to buy, correct? And similarly, he will sell the underlying asset because he's selling the right to buy. If he sells the right to buy to someone, that person has a right to buy from him, correct? Then on the right to sell, which is the put option, we studied that in case of a put option, the buyer of the right to sell is the buyer of the right, but he would ultimately be seller of the underlying asset, correct? Because he's buying the right to sell. So in future date, he's going to sell. Similarly, the seller of the right is actually the buyer of underlying asset, because here the right is to sell. If he's selling the right to sell, he will have to purchase the asset in future, correct? So what we said is buyer of the right is also called as holder, seller of the right is also called as writer. And then we introduced another term called premium. We said that since there is a right to buy, there is a right being sold by the writer will expect a premium in return. Then we studied about this example in which we studied about on expiry, how are the payoffs going to be. So the bottom line here is, in case of a holder call option, better if prices goes up or beyond the strike price. In that case, holder will benefit. In case of put option, if the price goes down below the strike price, then only the holder will benefit. Correct? Then we studied what is the difference between options and futures. Everything is same except for the fact that here the holder have an option, here there is no option. Here they have to, there is a mandate to do the transaction. There is a right. Correct? That's the only difference. Now, then we studied on the payoffs from the call option buyer, holder, or long call perspective, in which we said that loss is limited and gain is unlimited. Correct? That's what we said. Similarly, for a call seller, the person who is doing a short call, the gain is limited. For him, the gain is limited to only 5 rupees. That is the premium. And loss is unlimited. There is no limit to the loss. It can go, the moment the price will go steep high, it will go, the loss of the seller will go unlimited. Correct? Now, in case of a put option, again, put option for holder, the loss is limited. Correct? Loss is limited by, because ultimately maximum he has to bear the loss of premium, and gain is unlimited, because if the price goes beyond the 35 rupees in this case as we studied, then he will accrue a unlimited gain to him. Similarly, for put option seller, from the seller perspective, the gain is limited to only 5 rupees as we discussed above, and loss is unlimited. Here the loss is very unlimited. Correct. Then we said that how the trading happens. For equity, there is a spot price. For futures, there is a future price on which buyer and seller trade. But for options, there is a premium on which the sale and purchase happens. Then these are some of the questions. Now, what we studied next is what is the value of an option. Value of an option in case of a call option would be expected price minus the strike price. And this difference is the value of the option on a future date. To bring it to a present date, we do a present value of this difference. Similarly, for put option, strike price minus expected price. Then let us go down. Yeah, then we studied on the valuation technique. So this was our first model, binomial model. There was a spelling mistake here, BINOMIAL, binomial model. So we said that buy means two, buy means either one or two. One is the upper price or the lower price. So the entire model says that at any given point of time, there can only be two ways. One is that the price will go to high, or second one is the price will go to the lower extent. If the price is going to the higher extent, then what is the payoff? We have to calculate. Similarly, at lower extent, what is the payoff? We have to calculate. And we have to calculate the risk neutral probabilities. These are not the actual probabilities. Again, I'm saying this is what in the last session also I told. This is not the actual probability. These are just the risk neutral probabilities. Then we have to find out the probability adjusted payoffs, which is this, and take a total of it. If the question asks us to do a present value, we will do a present value. Otherwise, if it asks that what is the value at the expiry, then we will leave it here. Now we said that how to calculate probabilities. There are two options. For the price going up, we have to use this formula, 1 plus R minus D divided by U minus D, where R is the rate of interest expected, D is the proportion of the reduced price, and U is the proportion of the increased price. Then we said that there is another way to calculate the probability by using this equation, in which we say that current spot price is equal to the weighted average price multiplied by the respective probabilities, taking a present value of it. Correct? And in this case also the answer is same. So value of an option is the present value of probability adjusted payoff. Simple. So this is the value of the call option. Then as a next thing, we did 18th and 19th question. Now as a last concept here, I'm just putting a phrase which holds true. So Jitendra is asking, in option have actual delivery if we exercise option. Okay, so Jitendra, so in options, generally there is no actual delivery. Okay, generally there is no actual delivery. Generally it is settled through the net amount, as we have been discussing in some of the questions above. So they will not pay the entire amount and deliver the shares. That's not going to happen. Okay, Jitendra, it's only the net kind of settlement. So now there is a question that comes to our mind, that binomial model is actually relevant for both the type of options. American options and European options. Why I am saying this? Because in the last question, students, if you recall, we have made a different tree. Correct? These were the different nodes A, B, C. Then from here also there were different nodes. Correct? And from here also it can be different nodes. It can go on up to unlimited time. Correct? So this tree can expand or can be made or can be extended for a lot of time periods. Hence, in American options, the valuation technique, what it says is that, see, European says that what is the value at the end of the expiry. So in that case, node A and node B and C, this will be the expiry period. Correct? This will be the expiry period. So B and C will be end of the expiry date. But in case of an American option, this will be the expiry period. Correct? It will not be up to B and C. It will be up till all the possible nodes during that period. Correct? Hence, this binomial model is suitable for both American option as well as the European options. Okay, students? Let us go to the question number 20, which is the last question on this subject. Then we will go ahead and do the Black-Scholes model. Okay. So question number 20 says the current market price of an equity share of Penchant Limited is 420. So they are saying that the spot price is equal to rupees 420 within a period of 3 months. So the time is equal to 3 months. The maximum and the minimum price of it is expected to be rupees 500 and rupees 400 respectively. If the risk-free rate of interest be 8% per annum, they are saying that R is equal to 8% per annum. What should be the value of a 3 months call option? T is equal to already that we are given is a 3 months, correct? Time is already we have taken 3 months. So they are asking us to calculate the value of call option. Under the risk neutral method at the strike rate of 450. So the strike rate is equal to 450. So students, don't get confused with this risk neutral method. Risk neutral method is used to calculate the probabilities because those are risk neutral probabilities, and then we will apply the same principles of binomial model to calculate the value. Okay. Given e raised to the power of 0.02 is equal to 1.0202. This also they have given. Now students, see, if they have given e raised to the power, so is it prudent to assume that it is a continuous compounding quotient? Yes, because if they have given e, definitely the quotient wants us to make use of e, and that can be used in case of continuous compounding. So first of all, for under continuous compounding, we have studied under continuous So students, under continuous compounding, what we have studied is e raised to the power RT minus D divided by U minus D is the probability of price going up. Correct? This is the probability. So the probability that price may go up is given by this. Now, if you see the e raised to the power RT is what? Is a 3 months call option, right? So 8% is the R multiplied by T would be 3 divided by 12. Correct? This is what e raised to the power rt would be minus. D is what? D is the downward proportion. So downward proportion is 400 divided by the current market price of 420. Correct? Because we are at 400, 420 here. So the U and D are respectively calculated like this. So 400 divided by 420 whole divided by, what is the price going up? 500 divided by 420 minus 400 divided by 420. This will give us the probability of price going up. So then the probability is equal to, if we solve this, so now this part we can rewrite as e raised to the power 0.02 minus 400 by 420 divided by 500 by 420 minus 400 by 420. Okay. Then the probability will be 28.48%. So if we calculate and solve this equation by replacing e raised to the power 0.02 with what is given in the question, which is 1.0202, we will reach at the probability of this. So the probability that price would be 500 is equal to 28.48%. Probability that price would be 400 is equal to 100 minus 28.48, correct? Which is how much? 71.52%. This is the probability that the price would be 400, correct? Now, the next part is the value of the option. Now, can we say that what would be the payoffs? Payoffs, probability, then probability multiplied by payoffs. The price, we can put it like this. If it is coming out to be 500, the payoff will be how much? The payoff will be 500 minus strike price, not the spot price, correct? Because the payoff will be determined from the strike price of 450. So the payoff will be 50 here. Probability is how much? 28.48%, correct? Similarly, in case of 400, there will be zero payoff, 71.52%. So this is already zero, and this will be how much? 50 multiplied by 28.48%. So 14.24. 14.24 is the total probability adjusted payoffs, correct? And hence the value of call option will be 14.24 divided by the 1 plus r percentage. So in this case, again, since we are given E, we have assumed continuous compounding. So here also we will do e raised to the power RT, correct? Because e raised to the power RT, if we divide it by, we will come to the present value. So which is 14.24 divided by e raised to the power 8% multiplied by 3 by 12, which is further equal to e raised to the power 0.02. This value we are already given in the question, correct? So the value of call option is coming out to be 13.96. This is what the value of call option is coming out to be. I hope this part is clear, why we have divided it by e raised to the power RT. Sorry. Because if we have to calculate the future value, we multiply it with by e raised to the power RT. But if we have to calculate the present value, we will divide it by e raised to the power RT. Okay, students. I hope this question is very clear. Please do ask any question if you have up till now. Okay. Okay, we shall move forward now. Perfect. Now let's go to the next concept. Now, students, please listen very carefully from now here on, because we are going to cover a topic which will last for a lot of time and everything is interrelated. So please try to hear all the things very carefully. Okay. Now, we are going to talk about 4 cases now. Okay. Under options, we are going to talk about different types of cases. Then I will use all these different types of cases in the discussion going forward. So for example, case number 1, what will happen? So for example, in case we are doing long of call option, that means what? We are actually dealing in right to buy. This we are actually purchasing. Correct? So this means that the right to buy is purchased if we are doing a long call option. Now, if you're purchasing the right to buy, that means on a future date, you have to pay the strike price equivalent value to get the shares back. Correct? To get the shares back, you have to pay the strike price. So do you think, would it be prudent to invest the present value of strike price today? Yes, because if we are going to invest the present value of strike price today, on maturity, we will get the amount equivalent to strike price, which is the investment plus interest. That amount we will use to buy the shares. Correct? In this, now we have to assume that we are talking about the gross settlement, okay, not the net settlement. Just a second. So Naveen, okay, no issues, no doubt. Jitendra is asking if paid premium in question, then also added in value of option. Sorry. Yeah. So Jitendra, sorry, yeah, Jitendra. So this Jitendra, if you see, essentially, this is the premium only. This is what the premium is. Value of call option is what? Premium. You're getting my point. So in case the premium is already given in question, then question will not ask us to calculate this, because this is the minimum premium expected by a writer. We're getting the point. This is the okay. Now your next question, Jitendra, is whether it is from the point of view of call holder or call writer. Now hear me out very carefully, because that's a very interesting question. So 13.96 is a theoretical calculated premium. Okay. In theory, we have calculated this. Now what will happen? Call holder, call writer. Now see how they will deal. This calculation is done by call holder also. This calculation is done by call writer also at both their ends. Correct. Now what call holder will say? Maximum I can go up to 13.96. Anything below this will help me. I can go maximum up to 13.96. I can't go beyond that, because as per the calculation, it is 13.96. I will not pay any 1 paisa extra to this 13.96. This is what call holder will think. Now, what call writer will say? I will expect minimum of 13.96. Whatever higher I can negotiate, that's a gain for me. Correct? Because ultimately, it's about the negotiation also between both of them. Correct? But ultimately, if this is the maximum for call holder, this is the minimum for call writer, the deal will be done at 13.96. So I am giving you the perspective because you are asking that it is from which point of view. Hence, I'm giving you the call holder perspective will be maximum 13.96. Call writer perspective will be minimum 13.96. Okay. So this is the perspective that they will carry, and the calculation will be done by both of them because the data is same. Okay, now coming back to the case number one, as we were discussing. So the case number one, we said that there is a right to buy happening a long position there. Okay, that means we are purchasing the right to buy. Now, as I was saying that since we have purchased the right to buy, that means on a future date, we have to invest, sorry, we have to pay the amount to get the equity shares if we assume that we're talking about the gross settlement here, correct? So, step one, this is part of one only. Then step two will be invest present value of strike price today. So that after expiry, you get the strike price equivalent amount, correct? And that you use to purchase the equity share. This is very simply case number one. Now, case number two. Now, I would want responses from all of you, correct? Because that this case number two and these four cases are very interesting. I'm saying I'm going to base the put call parity theory and the Black-Scholes model on these case fours, on these all four cases. So hence, please listen to this very carefully and please respond also. So the case two is if I'm shorting a call option, I'm shorting a call option means I'm writing a call option, I'm selling a call option. In that case, what I'm doing is I'm still dealing in right to buy, but I am selling this right to buy, correct? I am selling this right to buy. Now, can any one of you tell me if I'm selling you the right to buy, what action should I take today so that on a future date when settlement happens, I can settle this position? You're getting my point? This is one only. This is also part of one. Now, what action? So in this case, I have invested the present value of strike price today because I have to pay. Here, I am receiving the payment and I have to deliver the shares. So what is my obligation? To deliver the shares, correct? Because I am selling the right to buy. In case that right to buy is exercised by the option holder, I have to deliver him the shares. So what I'm going to do is, what would be the actionable from my end? I will purchase one share today. Purchase one share today. Okay. I'm just removing one here as of now. We will just focus that we have to purchase one share today if we are undertaking a shorting of call option. These are some of the strategies that I'm discussing, correct? If I want to long a call option, better to invest the present value of strike price today. If I want to short a call option, better to purchase a share and keep it today because on expiry, if the settlement happens, I have that share to settle it out. Okay, students? And these will help you in doing the strategy also. Yes, Naveen, perfect. Long in cash market, very good. That means purchase the shares today in spot market. Purchasing means long. Very good, Naveen. Okay. Now going to case number three. Case number three is I am doing the long put option. That means I am purchasing the right to sell. Now please tell me what I'm going to do here. I will repeat this. Long put option. That means I am purchasing the right to sell in case I am going to exercise the option of right to sell on a future date. That means what I will have to do is, if I'm selling the share, yes, Harshad, you are also right. Buying share today at spot price. Harshad, you have responded to case number 2. Maybe the response have come to me delayed, but you are also right, Harshad. Very good, Harshad. Jitendra is saying hedging concept. Yes, these are all hedging concepts only, because with this strategy, there will be no gain, no loss. If you do a shorting of call option, if you do a long of call option, long of put option, there will be no gain, no loss. These are all hedging options, because we are taking the balanced positions in both the markets, spot market as well as the FNO market. Very good, Harshad. Very good, Naveen. And Jitendra is also saying hedging concept. That's right, Jitendra. Yeah. So long put option, what we are going to do is we are purchasing the right to sell. If we have purchased the right to sell, that means on future date, once we are expected to do the settlement, what we have to do it today. Very good, Naveen, and very good, Harshad. Buy today in cash market. Very good. So that means we have to again purchase share today and keep it, so that, because we have done a long of put option, so that on a future date, on expiry, once the time comes, I will deliver the shares and I will sell the shares. Correct? Case 4, short put option. That means I am selling the right to sell. Right to sell is being sold by me. Correct? I'm sorry. I'm just use the same. Selling the right to sell. If I'm selling the right to sell, that means on a future date, what I have to do is I have to purchase the share. Correct? Because the put option holder will sell the share to me and I have to purchase the share. If I have to purchase the share, what I have to do today in the market? Tell me what I have to do today in the market. If I have to purchase the share, what will I do today in the market? Namita is saying, sir, if option is for some period, is it possible now that we can purchase share just before 2 days of settlement? Yes, Namita. See, Namita, that is what the American option is. See, American options gives you a right to purchase, to sell, I mean, to execute the right, whatever is the right is, to execute the right up to the expiry on any date. That's what we discussed in the. This is the American option, 0 to 3 months, correct? 0 to 3 months is the option. Now, for American option, you can execute here also, here also, here also, anywhere. And even here also, just 2 days before the expiry, whenever you want. But in case of European option, there is a 0 to 3. You can only execute at third place here. You cannot execute anywhere else. Yes. So Naveen is saying short in futures. Very good, Naveen. A very good attempt, Naveen, because I can understand the thought process that you have. But since we are just one point I just forgot to tell you is that in this case, we have to do the options and spot market only. So basically, we are talking about the options and spot market. So what we are going to do is in spot market, we are going to invest the present value of strike price today. Strike price today. Why? Because on expiry, we would need this amount if we are shorting the put option, correct? That means we have sold the right to sell. If someone executes this, that means they are selling it to us. We have to pay them the strike price today, strike price on a future date. Hence, we have to invest present value of strike price today. And Naveen, I totally agree with your answer. Short in futures is also right. Short in futures is also right because that will give you the same effect of investing the present value of strike price today. But the only thing is, shorting futures might come at a different price than the strike price. You're getting my point? Because in futures market, what can happen is the futures would be trading at something else and the strike price would be something else. Here we have to, hence, just to be very accurate, we will just take the present value of strike price and invest it. Okay, Naveen, but I totally agree with the concept, with the thought process that you have. Namita is saying sell shares today. Very good, Namita. I will explain this also. Harshad is saying invest idle cash or hold cash. Perfect, Harshad. That your understanding is also correct because we are investing the present value of strike price. Now coming to your point, Namita, let me go one step back and say since you're saying sell shares today, correct? So what will happen for a perfect hedging situation? You would see that in the time to come, in the classes to come, and in the previous classes also, for doing the perfect hedging, we always assume that we have zero money with us. Whatever money we want, we will borrow it and then we will invest it. And similarly, after the investment will come, we will repay the loan. That is what we assume for all the hedging situations. So some of you would be wondering from where this present value of strike price, let's say this is 100 rupees, is coming from. Correct? Where this is coming from. That means there are two ways from where this will come from. One is by shorting the shares today. If I short sales the shares today, that is against the concept that I've told you. Because earlier I told you that you can't short sell the actual shares apart from intraday, correct? Within intraday only is what you can short it. But still I'm saying just from the technical perspective, because in some markets the short sell is still allowed beyond intraday, but in India it's not allowed, correct? So hence I'm saying that there are two options. One, you take a loan of 100 rupees and invest it. Second is you short sell shares today, whatever is the amount you receive, out of that you invest the present value of strike price today, correct? But let's not go into that debate because that debate will open up a lot of things. But Naveen, your thought process is also right. Namita, you're also right. And Harshad, you're also right. All of us are saying on the same thing, which is invest present value of strike price today, either through short selling of this thing or to invest the idle cash or to take the loan and invest. Okay. Let's restrict our discussion up to here. Okay. Now, these are the four beautiful cases that we have discussed. Case number 1, case number 2, and case number 3. Now, students, please note the next point. Let me do one thing. Okay, let it be here. As we have discussed that on a stock exchange, the buyer and the seller is there. Now we are talking about only for options, correct? So the price of options is what? Premium. The premium is the price at which buyer will also bid and seller will also bid. And if the premium matches, there will be a deal between both of them. Now let's say today there is a premium of rupees 8. 8 is premium. And buyer purchases it, seller sells it at 8 rupees. Any option I'm talking about. Tomorrow the premium goes to rupees 10. Correct? That means the buyer will have a plus 2 rupees and seller will have a minus 2 rupees because of the long position and short position. Just imagine that this is similar for an equity share. Correct? If the prices goes up, buyer will gain, seller will lose. Similarly, in case of an option also, whether it is a call option or a put option, if the pricing goes up, buyer will gain, pricing goes down, seller will lose. Simple. Whether it is a call option or a put option, the same principle will apply. But what I am trying to say here is, you just remember this one line. Yes, Namita, you can do that. I was saying that we can purchase or sell shares in cash market just before 2 days of settlement. Yes, you can do that in case of American option, but okay, in case of an American option, you can do that. And Jitendra is saying hedging is available in cash, equity segment, future. Yes, Jitendra, hedging is available everywhere. Hedging is available even in India market and a New York market also. Hedging is available in 2 different markets. See, what is hedging is? Hedging is always carried out in 2 different markets to make riskless profit. Okay. So just remember this line. Option is always reflective of the extent to which it is in the money, adjusted for time value of money. See, student, this is a very beautiful three lines which concludes the entire thing on options premium. So we can put here option premium. Okay, option premium is always reflective of the extent to which it is in the money, at the money, out of the money. You remember in the last class we discussed, in the money means that it is beneficial. Correct. In case of a call option, the spot price is higher than the strike price, then it is in the money. Vice versa, it is. In case of a put option, if the price is lower, then it is in the money. Correct. So, how this premium will get impacted? Higher it is in the money, higher will be the premium. Lower it is in the money, lower will be the premium. If it is at the money, premium will be zero. You go and check in the market. If it is out of the money, still premium will be zero. Nobody would be willing to buy it. Simple. So it is always reflective that what is the extent to which it is in the money, and that in the money that which has to be paid in future is adjusted for the time value of money today. You're getting my point. So option premium is always reflective of the extent to which it is in the money, adjusted for time value of money. Simple. Because if it is not carrying any money, it is not carrying any value for the traders to trade in, why will the premium be priced at some price? So if it has moved from 8 to 10, can anyone tell me what would be the only factor because of which this 8 to 10 movement has happened from day 1 to day 2? For example, this is day 1, this is day 2. What is that factor because of which the movement has happened from day 1 to day 2? That is because the price expectation, the spot price expectation on expiry has increased, because of which the in the money factor has also increased. So between day 1 and day 2, day 1, day 2, what is really helping us out here is day 1, the expectation would be, let's say, expectation of spot price would be, let's say, it would be 100 rupees. For example, our strike price, here it is 80 rupees. I will prove all this mathematically, but I'm just first building the concept. Okay. And this is what the Black-Scholes model also assumes. Okay. But still, I am saying expectation of spot price on day 1 is 100. Let's say on day 2, the expectation increases. Expectation on spot price increases to 150. Strike price is still 80. Don't you think? Yes, Naveen, you're right. Price rise of underlying. So this is what the price rise of underlying is happening. 100 to 150. Because of this, the in the money value will be higher now. Correct? What was the in the money value earlier was 20 rupees. This is day 1. Day 2 will be how much? In the money value will be 150 minus 80, which is 70 rupees. So this difference has led to the higher premium. Higher premium. Correct, students? I hope you are able to understand my point. What I'm trying to say is that it is always reflective the extent which is in the money, adjusted for the time value of money. Simple. Let us go to the question number 21. Then we will do the concept of Black-Scholes model and then question number 22. Namita is saying, sir, these out of the money at the money will be known at the actual expiry of contract. So why premium will exist on the expiry? Yes, Namita, that's what I'm saying. At the expiry or sorry, at the money or out of the money, in both the cases, the premium will be zero because the people who are dealing it knows that on a strike date, on a expiry date, there is no value that this contract is going to give. So nobody is willing to pay any premium on that. There is nothing that will happen. Hence, the premium will automatically be zero. Okay. Now coming to question number 21. AB Limited's equity shares, AB Limited's equity shares are presently selling at a price of rupees 500 each. So what we are saying is that there is a company called AB Limited. Their equity shares are currently being sold at 500. That means the spot price is 500 rupees. Okay. An investor is interested in purchasing AB Limited share. Now, students, please note this is a very important line because this will devise our strategy. Correct. What is the strategy? Is that investor is interested in taking a long position in purchasing the AB Limited's equity share. That means in the mind of investor, it is already there that the prices will go up. Hence, he is interested in purchasing the shares. Correct. The investor expects that there is a 70% chance that the price will go up to 650 rupees or a 30% chance that it will go down to 450. So currently, what is the price? 500. There are two chances. So there is a 70% chance that it will go up to 650 rupees. And there is a 30% chance that it will go down to 450 rupees. Seems like similar to the binomial model, correct? We are given two results. One is 650 and one is 450 with the respective probabilities. And all this will happen 3 months from now. Today, and this is 3 months. 0, 3 months. This is how it is going to happen. Now, there is a call option on the shares of the firm that can be exercised only at the end of 3 months at an exercise price of 550. Exercise price is equal to 550. Time is also given as 3 months because everywhere we are saying that this will also happen in 3 months. The call option is also exercisable after 3 months. So that means it is okay. Only at the end means this is a European option. Correct? It's not an American option. European option. See, you have to understand each and every word in the question that is given, correct? And make it out that what the intent of question is. Now, the next part is calculate the following. If the investor wants a perfect hedge. Oh, perfect hedge. What combination of shares and options should he select? Now, what is the perfect hedge between a shares and option? Okay, just now, students, we have discussed what position to be taken in share market and what position to be taken in options market. Okay, let's wait. Namita, your query is how buyer of an option know today that this option will be out of the money or at the money in future so that they not pay premium today. Okay, Namita. So that is what the estimation will come into play, right? So Namita, that's where the expectations or the estimations of an investor will come into play because he will have some expectations in his mind and hence we always work with probabilities. Correct, Namita? Since the future is not certain in terms of the outcome, hence they will work either with the probability or they will use the Black-Scholes model, which takes a futuristic view to calculate the premium today. Okay, Namita? So this is what it is going to be. Okay. then only they will be able to decide. See, all this is calculations happening. The actual outcome would be different, correct, Namita? And hence, the expectation versus outcome is always not aligned, correct? There can be difference. Now, I expect that it should be out of the money on expiry. Hence, I am paying zero premium. I will not do it. But actually, it can become in the money also because of some change events that happen in from today to expiry date. It can be anything, correct? So this cannot be definitely predicted. Actual thing cannot be. Hence, we are using the probabilities in case of binomial model. We will use volatility, other things in the Black-Scholes model. Okay. Hence, let us see that whatever we expect is not definitely guaranteed in terms of the outcome. Okay. So hence, through his expectation only, he will come to know, okay, it is at the money, out of the money, hence is not entering into the deal. That's all. Or through his expectation only, he will come to know that if it is in the money, that what is the extent of in the money and what is the maximum amount that he can pay. Okay, now students, please note here, we are talking about a perfect hedge. Okay, now first of all, let us know what is the perfect hedge. See, perfect hedge is given differently in the different situations. Now, specifically for binomial model, in case the question is towards binomial model, the perfect hedge is given by payoff at higher price minus payoff at lower price whole divided by higher price minus lower price. Okay, students, I will elaborate it. Payoff at higher price minus payoff at lower price. This is the option payoff we are talking about. And these are the higher price minus the lower price itself. Now let us try to calculate that. So first part, perfect hedge would be given as, now students, if you see what would be the payoff here. So 650 payoff will be compared against 550 of the exercise price, correct? So the payoff is 100. Similarly, here the payoff is 0. Let's write it here properly. See, perfect hedge. First of all, we have to calculate payoff if price goes up at 650 rupees. So it will be 650 minus 550, which is equal to 100 rupees. This will be the payoff. Payoff if price goes down at 450 rupees. So this will be 650 minus, sorry, 450 minus 550, which is 0. Because payoff cannot be negative, correct? We cannot ask the option holder to pay it to the option writer. Hence it is nil. This will be nil, correct? So the hedge ratio will be, I will tell you what is the hedge ratio, okay? What is the meaning of hedge ratio? First of all, let's calculate the hedge ratio. 100 minus 0 divided by 650 minus 450, higher price minus lower price, correct? So this will be 100 divided by 200, which is equal to 0.50. Now, students, if you see, we are saying that hedge ratio is 0.5. Now, what does this mean? Meaning of hedge ratio. So hedge ratio will mean that how many shares to be traded. I'm using the word traded. That means buy or sell, because that will depend on what you are doing, whether you are taking a long position in call option, short position in call option. Hence, I'm using the word traded. So how many shares to be traded for one option? This is what the meaning is. Because see, it is not always 1:1. You cannot do it like this. That for writing one call option, I will purchase one equity share today. No, because there are different chances. Correct, right? So there are different expectations, and hence the value differs basis the different expectations. Hedge ratio is trying to give you a proportion between what should be the optimum share quantity compared to one option. Okay, this is what is called as hedge ratio. This we have studied in the futures also. What is the correct hedge ratio? In options also, it will come in two different manner. This is the hedge ratio that is given under the binomial concept. This is the formula. Okay, how many shares to be traded for one option? Simple. So that means this gives us that 0.50 shares to be traded for one option. Then only you will be able to achieve a complete hedging. You're getting my point? Then only you will be able to get a complete hedge, a perfect hedge. Whichever way the price will move, the total gain or loss will be zero. Namita is saying, sir, so if buyer can use expectation as a tool, like I am expecting that option will be out of the money to avoid payment of premium, that yes, Namita, that is right. Because he will go to the option holder and say, according to my expectation, the premium should be zero because I expect it is out of the money. Hence, I'm not paying you anything. That is right. Okay. Now, students, if you see, the question has earlier said. Now, what next confusion I have? I came to know that okay, zero point 0.5 shares needs to be traded. Now, in traded, what should I do? Whether I should purchase it or should sell it? For that, we have to refer to quotient, because whatever position we take in spot market, the same thing will apply to the options market. We have to devise that in options market, we have to do what? Do we need to do the writing of call option? Do we need to purchase the call option? But for that, we need to first determine what we need to do in spot market. Then only we will be able to determine what we have to do in the options market. So as far as the spot market is concerned, the question has very categorically said, and I have also asked you to note this point, that an investor is interested in purchasing the AB Limited's share. That means in spot market, he will be purchasing the shares. If in spot market he is purchasing the shares, now I am coming to one of my case, the four cases that we have discussed. But ultimately, let me write here. The investor, first of all, I'm writing the question solution part. The investor should purchase 0.50 shares for every call option. For one call option, he should purchase 0.50 shares. Now, what I'm trying to say here is, if he has purchased the shares, what he should do in the call option market? He should purchase the call option or he should sell the call option. First of all, we cannot go to the put option. Why? Because the question again has only indicated that there is a call option. That's all. They have only indicated there is a call option. Now, tell me one thing, what he should do with the call option. If he's purchasing the shares now, he should write a call option, correct? He should sell a call option, because if he has purchased it today, he should sell a right to buy. If he's selling the right to buy, that means tomorrow the holder will ask the share from him, and hence he will be able to give that share to the holder, correct? So second point, explain how the investor will be able to maintain the identical position regardless of the share price. So investor, now let us prove this. They are saying that what if the price goes to 650? What if the price goes to 450? How are you going to substantiate that whether this perfect hedge ratio is working or not? That is what we will do it now. Investor can purchase 0.50 share for one call option return. This is the strategy that we have devised. Now, let's go to the A part. If spot price on expiry, if price on expiry is 650, then what is going to happen? He has how much of shares? 0.5 of shares. Actually, practically, you can't do that. But I'm using 0.5 just to, because this can be increased to, let's say, 2 also. If we are taking, 4 options, then it will be increased to 2. It can be increased to 1 if we are dealing for 2 options, correct? But I am taking 0.5 as of now. So sale proceeds will happen as 0.50 into 650, which is equal to 325. This is what the sales proceeds is. Okay, this is one, and then less. Since this is 650 rupees, he has written the call. He has written the call. He has to incur a loss, less loss on call option. How much would be the loss? 650 minus 550. Because on expiry, the price is 100 rupees more than the strike rate. So 100 rupees is a loss. 325 would be the sales proceeds. 225 is the net cash inflow. This is all happening on expiry. Minus spot purchase today is how much? Spot purchase today is, what is the spot price today? 500. 0.50 plus he will have some premium also, correct? Once he will write it, he will have some premium also. We are not going to the initial cash flows there as of now. Okay, we are just representing the, because we are not given anything on premium, hence let's not go to the initial cash flows. We will just close our answer with the net cash flow at the end. Now if our net cash inflow also becomes 225 at 450 rupees, then we are sorted. That means there is a complete hedge. That means whatever we do, our net cash outflow is restricted to 225. Now B is, if price on expiry is 450, then proceeds from the sale of shares will be 0.50 multiplied by 450, correct? This is what the sale proceeds is. This is going to be 225 minus loss, which is nil, because 450 minus 550 is equal to nil, correct? There is no loss, there is no gain. So ultimately, it's 225 only. Sorry. So that means whatever is the price at price 650 as well as 450, the net cash flow, the net cash inflow on expiry remains same. Hence, there is a complete hedge. This is what the question was asking, correct? Now, Naveen is asking, sir, but writing an option has an unlimited risk. That's right, Naveen. Will this work as an hedge? Very good. So, if you see, definitely writing an option is a riskier situation because it has an unlimited loss. But if you see, given the facts of the question, if you see given the facts of the question, see, because binomial model have some limitation. What is the limitation? It assumes that either the price will be 650 with a 70% chance, or the price will be 450 with a 30% chance. There is no other option available. If you are given this with very much surety that 70% chance is for 650 and 30% chance is for 450, in that case, writing an option will be better and purchasing an share will be better. Okay. Because the unlimited risk will come if the price goes to 700. But the question is very clearly saying that it can only be 650 or 450. Okay, Naveen. Hence, thought wise you're right that it has an unlimited risk, but since we are already given that the price can only be 650 or 450, hence we are operating within that data points. Okay, because of this information only, this person, who is this person, Mr. X or Mr. A B Limited, an investor. So whosoever is this investor is, this investor is very much is very much estimated that there cannot be any other price. Hence, he is very sure that this is what I am going to ask. Okay. Okay. I mean, so there is a complete, so there is a complete certainty that the price is going to be 650. Hence, he is willing to do this call option underwriting. Okay, Naveen. Jitendra is asking hedge ratio in terms of quantity or in rupees of invested. No, no, no. Hedge ratio is in terms of quantity, Jitendra. Jitendra is asking again a logical question which says that whether hedge ratio is in the quantity or in rupees, it is always in quantity. Hedge ratio will give you how many shares against what number of options to be traded. Okay. Thank you, Naveen. Now let us go to the third part. Where is our question? Yeah, this one. Now see the third part. Yes. So the third part says AB Limited, sorry, if the risk-free rate of return is 5% for 3 months, they are giving that R is 5% for 3 months. What is the value of the option at the beginning of the period? What is the value of the option at the beginning of the period? Now, value of the option means they are asking about the premium, correct? Because the value of the option is nothing but the premium, correct? Okay, now this is a something which is a very, you know, typical part, but let us try to attempt this. We will form one equation, through that we'll try to calculate the value of the option. Now, think it from the investor perspective. Okay. Now think it from the investor perspective. What investor have done here? This is actually a very good question because this will test all your logics. Now, as an investor, I'm just doing a rough work here, not part of the solution. As an investor, what would you think? Because you have done two things here. You have purchased 0.5 shares and you have done a right call option, correct? You have done a right of call option. This is one quantity, this is 0.5 share, correct? Now, we know that cash flows is going to be how much? 225, irrespective of the price, whether it is 650 or 450. Now, on this only, Namita is asking one question, sir. If this cannot happen in real life, that price can be 650 or 450 only. It is only books. So why are you using binomial model? Yeah, that's right. Practically, it cannot happen. But see, where you use binomial model practically, I'll tell you. We said that in American options also you can use binomial model. So in every second or in every minute or in every 10 minutes or in every 1 hour, you can predict that what are the two possible prices and do that simulation again using some complex machines called, in which there will be algorithms and there will be a lot of things. So using the logic, you can do this. Okay, but what I can tell you, Namita, is that definitely in real life, you cannot restrict only to two options. But what this binomial model does is for every second, it can predict two options with probabilities. Correct. And hence, there it might have some relevance for the calculation of this thing in the practical life. But practically, even I have not, we have not used this, but still, from a conceptual building and thought process, we have to understand it so that it opens up our mind that how the calculation has to be. Okay. Then what I was explaining here is basis the different prices of 650 or 450, we know that our cash flows are intact 225 on expiry. Correct. So if we assume, let us assume the value of call option, which is nothing but the premium, correct? This is the premium only, B, P, correct? Let's assume the value of the call option to be P. Now, students, if you note here, I was trying to fulfill this, but since we don't have premium, hence I have not done that calculation of the initial cash flow. Now the question is asking us to do that. Okay. So what we are going to do is, as an investor, I have these as cash outflows, and I have this something called as cash inflows. Cash inflows, I have already have it 225 on the expiry. Correct. To make it to the present value, I will do 1 plus R. Correct. Why I have done this? To make it to the present value, 1 plus R. Because 225 is on expiry. And this cash outflow is happening today. So first of all, what is the cash outflow? 500 into 0.5. This is the purchase price of 0.5 equity share. Correct? This is the purchase price of 0.5 equity share. And while writing the option, I will receive a premium minus P. This is our equation. Simple. Because while writing one call option, I will get some cash inflow as premium. My cash outflow is 0.5 into 500. This P into 1 I'm mentioning here because I will get premium into one equivalent call option. Correct? I think this is more or less the same thing that we have done here. Minus plus, if you see, minus plus, and then we were trying to reduce it from 225. But now here we have equated to 225 because that is what the investor will say that my cash inflows should be equal to cash outflows. Then only that is the bare minimum premium that I will expect on writing one call option. Correct? To better clarify this, this is cost paid for 0.50 shares. And this is income on writing one call option. And this entirely is the present value of cash inflows irrespective of price. Irrespective of price, whatever is the cash inflows present value, this is represented by this. Correct? Now, finally, if we solve this, it comes as, and this 1 plus r now, I'm just putting a proper equation here, 0.50 minus p is equal to 225 divided by 1 plus, what is r? R is rate of return for 3 months. For 3 months, how much it is given? 5%, correct? So we will just simply take 5%. Okay, students. So this is the equation. If we solve this, then it comes out to be 250 minus p is equal to 225 divided by 1.05. 214.2857 minus 250. So 35.71. So P is equal to 35.71. Correct? Hence, the value of call option, which is nothing but the premium, is equal to 35.71 rupees. This is what the next part was asking to us to calculate. Now coming to the last part. What is the expected return on the option? Now see students, what is the, while calculating the expected return, now I want, what is the investment equal to? Only the margins. Namita, because value of an option is premium only. Both the terms are used interchangeably. What is the value of an option? It is premium, right? What is the value of an equity share? The purchase price of the equity share. Correct. The market price of the equity share. That is the value of the equity share. What is the value of an option? At what price the options are traded in market? It's at premium. Correct. Hence, it is premium only, Namita. Now, I was saying that what is the investment? In spot market, we know it is total purchase price. Futures market, we know it is margins, because futures market, we have to pay the margins and then initial margin, maintenance margin, all those things. In options market, what is this? Now you tell me, I give you three options. A option, spot price. I'm talking you, if you have to purchase one option, what is the investment that you have to make? A is spot price, B is strike price, C is any other, please specify. If you want to choose C, then please specify what is that. Now let's expect some good answers. Whether it is a spot price, whether it is a strike price, any other price that you have to specify. What exactly do you mean? I am asking all of you, what is the investment in options market for purchasing one option? What is the amount that you have to invest? Very good, Namita. Premium. Naveen is saying premium and spot price. No, Naveen. So in options market, the investment is only premium, correct? Because in the earlier, this chart also, as we were discussing, wait, let it come. Yeah. In this, we said now that rupees 8 is the deal today on premium. And if 8 goes to 10, that means 8 rupees has gone to 10 rupees. So the option premium is the investment amount itself. Okay. Good attempt. So I can say that in options market, premium is the investment. Now to calculate the return, what is the question asking? Expected return on option. Expected return on option. See, first of all, students, if you see the investment is how much? 35.71. We have to calculate the expected payoff on expiry. Can we say that this is 100 multiplied by 7%? This 100 is calculated as 650 minus 550 plus 0 multiplied by 30%. This 0 is 450 minus 550, which is nil actually. This is nil, correct? So the expected payoff on expiry is the payoff on 70% price and the payoff on 30% price adjusted with the probabilities. So this will throw up a number of 70 rupees. This is the expected payoff. Everything is based on the facts that are given in question. Okay. Okay. Now the investment is given. The future expected payoff is also given. So what is first of all the return? Expected return in absolute amount will look like 70 is the total income, expected income, minus 35.71 is the cost. So it will be 70 divided minus 35.71. 34.29. 20 minus 35.71. 34.29 is the expected return. And the expected return in percentage will be calculated as 34.29 by the initial cost. Correct? This is the percentage. Coming out to 96.02 percentage. This is the expected return in the form of percentage. So don't get confused. Here the expected return is very easy in the form that how much we have invested and how much we have gained. What is the total return on that? On the total investment, that is our expected return. Okay. This question was a very good question because it involved a lot of out of the box concepts. Correct. But I think with this, we have covered a lot of conceptual building on options. Now, Jitendra is asking what is the role of upper circuit? Okay, Jitendra, upper circuit is generally there in the market to avoid. So if the price goes beyond some level of upper value, the trading will stop. Because, so for example, although it's not related to the curriculum, but let me explain if you're asking. So this is the spot price today. I'm talking about equity market. Okay, is the spot price today. So there will be two values to every price of equity share. One is the lower value, lower circuit value, and upper circuit value. For example, the spot price is 100, lower circuit value is 80, upper circuit value is 120. For example, I'm saying if the price in the same day goes from 100 to more than 120, the trading will stop here. stop the trading. Similarly, the price goes down from 80 here, the again trading will stop here. It happens. Lower circuit happens. Recently also it happened. I will not tell the exact company name and everything, but it was in news that it got onto the lower circuit on the day of listing itself. Correct. Similarly, upper circuit also happens. This is the role of upper circuit and lower circuit to curb the trading, to curb the excess volatility in market. So the role of circuits is to curb the excess volatility in market. Because with this, if the people if the people are doing the trading and they keep on doing the trading at higher prices, the prices will keep on going up. That's not how the market hygiene will be maintained. Correct. Naveen is asking why not use binomial method, sir. Naveen, you are asking in calculating the expected return, because see, parcel we have used here the binomial method only. Okay. I got it. So would mean to say that we have taken 70 rupees at the expiry. Are we not doing under the binomial model, as we said, the present value of this 70 is what you're trying to ask, Naveen? In that case, the actual return will not come, correct? Because the return has to include the time value of money. Hence, we have taken that today I'm getting what and future date will get what after 3 months. So this will also include the interest cost. So basically 96.02 percentage includes the interest cost as well as the other appreciation that has happened. Okay, Naveen, I hope this is what you were asking. If not, please elaborate the question. Naveen is asking a very good question actually. Now I got the question. So for evaluation of option in the third part, why are we not using the binomial model? We can use binomial model, Naveen, but if you see the flow of question, okay, it says that in the flow of question, it says that he wants to maintain some kind of a position, he wants to maintain some kind of a perfect hedge, and while valuing the option at the beginning of the period, we have to assume those things, correct? But on the other hand, if you use binomial model straight away, then also the solution is okay, right? But just to respect what is given in the question and to relate it from there, because see, as a hedger, now don't think that you are valuing just as a normal person, you are valuing it as a hedger because you are doing the hedging. Correct. You are doing first of all perfect hedge calculation. Then you are doing that what is the number of shares. Correct. And then you are proving that. Then in the third part you are calculating the valuation of that option. Hence, we have used that equation method to equate those things and calculate the value of option. This one. Okay. But no doubt in that you can use that other option as well of binomial model. In that case, the fourth part answer will get changed. Even the return also will get changed. Okay. But in that case, Naveen, we are ignoring that we have already done a perfect hedge. We are just checking that from outside, the this much will be the present value of the payoffs adjusted with probabilities. That's all. Okay. Namita is asking, sir, in case 4, how can we invest in strike price today in spot price? Please give example. Okay, in the case 4, you are saying, how can we invest in strike price today in spot? No. We are not going to invest in spot market, Namita. We are going to invest anywhere which will give us our percentage per annum of return. We are not going to invest in spot market. We will invest in FD. We will invest in any other risky securities which will give us our percentage, or whatever is that our percentage in market we are going to invest basically. Okay, we are not going to invest in spot market because spot market investment will happen only on the shares, correct? So don't confuse it there. Okay, now comes Black-Scholes model. So students, Yeah. Let me go to the explaining part of Black-Scholes model. Now, all of you, please listen very carefully, okay? Now you have to just listen for next 1 hour because each and every step is linked here. And this is already based on the discussion that we did in the first half, okay? Let me first clear the query box also so that I am free from my mind. Namita is asking question 2 and question 7. Okay, we will cover that, Namita. Jitendra is saying for expected return value of option considered or not. Yes, Jitendra. For expected return, we have considered the value of option. Correct? Because we have first of all taken the absolute return, which is the total minus the investment divided by the investment. Okay. Now, please, all of you, please pay attention here. Namita, we will cover the other questions in the later part. We will cover question 2 and question 7 again. Okay. Now, students, please see. We have studied 4 cases: case 1, case 2, case 3, and case 4. Let us go to the case number 2 in that and borrow the principles from what we all understood. Now, suppose there is Mr. A, correct? What was case 2? Case 2 was he purchases. So first of all, he sells the right to buy. Correct? Which is he's selling the right to buy. That means he's writing. He's doing a short call option. Correct? He's doing a short of call option. He's selling the right to buy. Similarly, he's purchasing the shares also. Correct? He's purchasing the shares. Because if he's selling the right to buy on a settlement date, he has to give those shares if the option is going to be exercised. These two steps he is doing A and B simultaneously today. Now, students, if you see from Mr. A's perspective, purchasing the shares is a cash outflow today. Is a cash outflow today, correct? And once he sells the right to buy, he will, I'm not talking about the premium as of now, because premium is what we are trying to value here. So premium, you keep it aside. Once he sells the right to buy on a future date, if the right is exercised, then he will get the strike price equivalent of money. So the cash inflow will be strike price, correct? The actual cash inflow will be strike price. In all these cases, we are assuming settlement on gross basis, that the shares will be given and price will be taken. Very simply, very easily, Black-Scholes model is saying for Mr. A, if he's purchasing the shares, cash outflow today is the purchase price. If he sells the right to buy, so on a future date, he will get the money in the form of strike price. That is the cash inflow. So the minimum premium expected by Mr. A would be nothing but the cash outflow minus cash inflow. Very easy, very simple. A minus B. This is the premium of call option. We will introduce certain complexities here, but first I am just trying to build a very basic concept here. Because you also, without going into any of the valuation model, if I ask you based purely on logic, you will also say that, okay, I will see through this decision that what is the total cash outflows, what is the total cash inflows. I will just reduce them to take out that what is the net amount I have to ask. Because cash outflow is more here. If you see, why we are doing is A minus B's cash outflow is more and present value of strike price is less. Hence, we have to recover that excess cash outflow in the form of premium. This is what Mr. A will think. Now tell me one thing. Cash outflow is happening today. This is 0 day. Cash inflow will happen after 3 months. Let's say time is equal to 3 months here. So after 3 months, cash inflow will happen. Now, in such a case, if the cash inflow is happening after 3 months, can we equate cash outflow? Let's say this is A and this is B again. A minus B I have done, right? Okay, otherwise we will get confused here. Let us assume this is Mr. X. Okay, otherwise there will be a confusion. Mr. X is the person name. A and B are the two cash inflows and cash outflows. So cash outflow is A and cash inflow is B. So we cannot do directly A minus B because B is a value that is sitting after 3 months. As per the present value and future value principles, what is the right equation to write here? A minus present value of B. We are building the formula now. Okay, students, we are building the formula. So this is called as premium. I'm writing here premium is equal to please listen all these things very carefully. Premium is equal to A minus B. This is a very simple concept, but in a layman it is A minus B, but for our language we cannot take A minus B because both of them are not the values on the same day. Those are the values on different days. Hence, the premium I'm rewriting as, we will evolve this formula slowly. So present value of B. Okay. Now, what is A? If we elaborate it further, purchase price of equity share. Correct? A is the cash outflow today, which is the purchasing the shares, right? This is the purchase price of equity share. Now, if it is a purchase price of equity share, that means, can I write this like this? Spot price minus present value of, what is B? What is B? The strike price. Okay, students. So the premium I am again rewriting here in the proper formula. Premium is equal to, let me not put a triangle here. So premium is equal to spot price minus present value of strike price. Okay, nothing new. Now, as we have studied earlier, that because this we are using the spot market, this spot price we are using the spot market, strike price is a result of options market. We have already studied that what should be the quantity of shares to be traded for one option, because one option is not equal to one share traded. In our strategy, we have seen that, correct? In the previous question also, we have seen that, because there is a concept called perfect hedge. Perfect hedge will give you what is the ratio of a share and what is the ratio of an option. If we are just restricting our formula to this step, then we are making an inherent assumption that one equity share and one option, which is wrong. Okay. What I have told you that to make a complete hedge, there is a ratio that is determined by something called hedge ratio, right? That will give us 0.5 share for one option, or it can be 0.7 share for one option, or it can be 3 shares for one option. This is actually an outcome of a hedge ratio. Hedge ratio is going to give you what is the number of shares for what are the number of options. Okay, students. Now, if that is the case, we cannot multiply it with 1. Okay, we will say that because premium is we are calculating for one option. Okay, so we will keep this one here, but we will multiply the spot price with hedge ratio. Okay, because hedge ratio nowhere helps you. Without hedge ratio, you are making an assumption of one option is traded for one share, which is wrong. One share has to be traded in the ratio of hedge ratio only. Then only you will be able to obtain a complete hedge. So what Mr. X will do now? Mr. X will rewrite the formula like this: premium for one option, okay, is equal to spot price multiplied by hedge ratio minus present value of strike price. Isn't this formula relatable? Is this formula relatable to what we have just done in the previous question? What is this? This one. You take this P, because in that we are valuing P, right? You take this P to here and take this amount here. Don't you feel the formula that we have written is same? Spot price multiplied by the hedge ratio minus present value of strike price, which is 225 by 1 plus R, this one, is equal to P. This 225 I'm saying is a result of the strike price, correct? It's not the strike price itself. I'm coming to that also. That is the last correction that we have to do in our Black-Scholes model formula. But for a moment, this is the present value of something that is getting derived from the strike price, which is this 225. 225 is derived from the strike price. Correct? In this formula also, we have tried to calculate the P. Using the same principles, I have built upon the formula till here. Now, finally, I'm writing it in a fair manner. Premium is equal to spot price multiplied by hedge ratio minus present value of strike price. Till now, we have reached till here. Okay. Our understanding is till here is fine. Now, if you see, students, in this, the last mistake that we are doing is we are assuming that our option will always be exercised. I am repeating the last mistake that we have done in this premium calculation in this formula is we are again doing an inherent assumption that in all the cases, our option will be exercised. Is this a right assumption to make? No, because there are chances that the price that the price will become unfavorable and the option will become out of the money, and hence the option will not be exercised. That is case number 1. Case number 2 is the prices will become favorable, the option will be in the money, and hence the option will be exercised. In that case, you can use this present value of strike price, correct? And the third thing is, if it is at the money, then also the option will not be exercised, or it can be exercised also, it will not give any benefit or loss. So premium is what? Premium is spot price multiplied by hedge ratio minus present value of strike price multiplied by the probability that the price on expiry will be higher than strike price. Then only this will be exercised. I am now finally writing the exact formula. Please note this point down. See, till now we were settled, correct? Our understanding will settle till now. But as I said, that if you are taking the present value of strike price in all the cases, you are making an assumption that whatever is the price, every time this option will be exercised, correct? But that is wrong. Option will only be exercised if the spot price is higher than the strike price, correct? So hence, we cannot ignore that fact that there is a probability attached to the spot price on expiry being higher than the strike price. That probability will have to take care. Okay, students? Okay, Namita, wait. Put option, we will go. This is first of all, we are discussing about call option. We will go to the put option also. Okay. Okay, Namita, I will exactly tell you the same thing for put option also. It is just a very simple cakewalk for all of you now. Okay. The premium is this. Now, I am writing the exact terminology used by the Black-Scholes model. I hope this is clear to all of you. So they use SND1 minus X minus E, sorry, E raised to the power minus RT ND2. Now wait, don't get panicked by this formula. There is nothing in this formula. It's just use of the fancy terms, that's all. See, I'll tell you everything now. I will use a red color pen so that this is spot price. This is ND1 is what? ND1 is the hedge ratio. Okay. This is present value of strike price. How is this a present value of strike price? Because X is the strike price itself. E raised to the power minus RT is bringing it from the future value to present value. Okay. Because this we can rewrite as X divided by E raised to the power RT. and this is actually equal to x into e minus rt, because if from the denominator, if you take something up, the power goes as minus, correct? So this is the present value, and this is also rewritten as a present value. That's all. X is here written as the strike price, and e raised to the power minus rt is giving the effect to make it as a present value. And the last part, nd2, is the probability that spot price on expiry is higher than strike price. Now, in this, I think all of you would have understood SX. Only apart from this ND1 and ND2. Now we will go on to this. So I'm just writing here S is equal to spot price. Okay. X is equal to strike price. ND1 is equal to the normal distribution value for D1. ND2 is the normal distribution value for D2. Okay. And D1 is equal to, now this is a formula that we have to remember. I cannot do the derivation of this D1, D2 here because it involves a lot of concepts on Brownian motion, other things. It's better to remember this formula. Natural log of S divided by X plus R plus standard deviation square divided by 2, multiplying it by T divided by volatility under root T. Similarly, D2 is equal to D1 minus V under root T. Thanks, Naveen. Okay. So D2 is equal to D1 minus V underscore T. Okay. Now, this is just a formula that we have to remember only. There is no other way. Why? Because these involves a lot of high level concepts on Brownian motion, other things. So let's skip that part because that is not even part of our curriculum. What we have to do here is now we have to see what all are these things. R is equal to risk-free rate of return. I can tell you one thing. The easiest part is Black-Scholes model in the entire derivatives. Why? Because there is just a formula. You have to remember it. There would be the exact values given in the question. You have to apply it. Sorry. And you have to arrive at a solution. That's all. It's just a simple formula application. Only that formula is big. That's all. Risk-free rate of return is R. T is equal to time to expire. V is equal to volatility, which is the standard deviation we call it, right? Standard deviation of what? Standard deviation of returns. Okay. And S is equal to spot price. X is equal to exercise price. We have already seen these things. Exercise price, the same natural log of S by X is what we are using there. ND1, ND2 we already seen. Okay, students. Now, I will explain this formula also, don't worry. Now, what is the next step? First of all, don't get scared with this natural log, okay? S divided by X. Very easy, very simple thing. See, you know there is a E, correct? E is called as exponential function. E is called as exponential function and it has a fixed value. It's a constant, right? It has a fixed value, correct? And natural log is called as in this manner. It is written in this manner. It is just the reverse of E, which is the exponential function. Now imagine, see, there are different types of logs, okay? We have studied log, natural log. This log we have to completely ignore because generally the logs are with a base of 10, correct? So don't go on that part. There is just a natural log which is a reverse of E, correct? For example, if E raised to the power A is equal to B, if E raised to the power A is equal to B, we can say that natural log of B is equal to A. We're getting my point. Because this natural log means the base is E here. The log base is E. Okay. So in case you have to find B, you can find it through this, or you have to find A, you can find it through B, through the natural log of B. Okay. Because let's say if you have to find A, you can just do a natural log of B and find it out. Simple. Correct? Nothing to worry in this. And most of the time, this value would be given in question. Natural log of S by X, whatever is this value is coming out to be, this will be given in question. So you don't have to worry on that. But still, I've told you that it is just a reverse of exponential function. Log is just a reverse of exponential function. Okay. So if E raised to the power A is equal to B, log of B will always be equal to A. Natural log of B is equal to A. Okay. This is one. Now let us understand this another thing. Now if you see D1 is a very elaborative formula. This includes the use of standard deviation, which is V square. In one of the places, Namita have asked that there is a uncertainty in the expectation, correct? I am also agreeing to that. You can expect something and actual can be different. To value that uncertainty, we are using this V, which is the standard deviation. Correct? We are using this V, which is called as standard deviation, because that will account for all the movement, all the unexpected movements in the price or in the returns, whatever it is. Correct? So hence this Black-Scholes model covers everything. Now, what if, okay, you tell me for a call option, okay, if strike price increases, sorry, if spot price increases, strike price cannot increase, strike price will remain same. Spot price increases, what will ultimately happen to the premium? Premium will also increase for a call option, because it will become in the money. It will become more in the money, correct? The in the money extent will increase. Now, can we prove using this formula that we have just now put? If the spot price increases, that means D1, which is having a log S by X as one of the part, will also increase. As a result of this, D1 will also increase. As a result of this, ND1, we will come to this, which is the normal distribution value of D1 will also increase. And as a result of this, S into ND1 will also increase. And as a result, the premium will also increase. Because if SND1 is increasing, that means the part before minus will also increase. That will increase the premium value. Okay. Now tell me one more thing. If there is a higher volatility, that means higher SD, that means the stock prices are bound to go up plus and minus very heavily. It can go to plus also, it can go to minus also. It is highly volatile. That means the standard deviation is high. Correct. Standard deviation is also high. With this we have studied in our portfolio management. Correct. Standard deviation represents what? Standard deviation represents the risk. Risk is what? The uncertainty. Uncertainty is what? The volatility. Correct. All these things are interchangeably used. Now, if V is high, this term will also be high. This will make D1 also high. And this will make ND1 also high. And hence it will also make SND1 also high. And it will also make premium high. Simple. This is the logic. If the higher volatility, higher will be the premium, because the uncertainty is very high. Okay. So this is just, I want to touch upon that this formula is based on those logics. Correct. And ultimately it will result into what we have already discussed in our conceptual understanding. Now let us come to the normal distribution. What is this normal distribution now? That's the last step now before our understanding is complete. So normal distribution. Many of you would also be knowing it, but let me just revise it. Because what happens now, sometimes the question is framed in such a way that you need to know exactly what is normal distribution, then only you will be able to apply the inputs. Now students, please see here very carefully. Something beyond derivatives, okay? Don't think normal distribution. Normal distribution is a very independent concept, first of all. What does normal distribution says? Let's say you have a series of data. What is a series of data? That means you have a historical data with you. Let's say you have it from stock market of X limited equity share prices. You have that past 10 years, you have that series. That day on day, what is the prices of the X limited equity shares? Okay. X limited equity shares, you have past 10 years of data. With this data, can you take out two things? One is mean and one is standard deviation. That obviously you can take it out. For mean, you just take the simple average, all the days data divided by the number of days mean. Standard deviation is the deviation from the mean. Then do the square and then do the under root, you will get the standard deviation. This we have already discussed how to calculate the standard deviation also in portfolio management. Now mean is represented by this, standard deviation is represented by this. Okay. Now using mean and standard deviation. So see, now this is the normal distribution. Assume that this is a normal distribution. It is a model. It is just a model. Okay. In this, the input goes as and the output will be a probability. So what this normal distribution will say that it will read the series through this average and through this standard deviation, it will do some processes on this normal distribution table which is there, and the output that you will get is the probability. Now, let me explain what kind of probability. Now, let's say in the series of data, you have 10, 12, 13, then again 11, 12, 13, 14, 15, then again 10, 11, 12. Let's say these are the prices on different days. That has already happened in the past. Okay. Now, using this, you can calculate the standard deviation and mean, both of them, correct, for this data series. Correct. I have taken in my example as 10 years data, but I'm just putting a lesser number of figures so that you can easily understand. Now, for example, the mean comes out to be, just don't ignore the values I'm saying, the mean comes out to be 10, for example, and the standard deviation comes out to be 3. Okay, it will not come out with this figures, but I'm saying whatever figures you take, basis that the mean and standard deviation is coming out to be 3. Now, what is the probability? Now, what is the question we are asking is that the probability that tomorrow the price will be 18 rupees. So, what is the probability? What is the probability that price is rupees 18 tomorrow? This question is answered by the normal distribution. Okay, see, if you plot normal distribution on a 2-axis chart, it will look like this. Naveen, I'm coming to that. Cumulative probability, I'm coming to that. Okay, let's first understand the normal distribution. So this is equal to the U. Now, this value is what? U minus standard deviation. This is U minus 2 times of standard deviation. This is U minus 3 times of standard deviation. This is right, correct? U is 10 minus 3 into 3 is 1. Here, if you see U plus standard deviation, U plus 2 times of standard deviation, U plus 3 times of standard deviation, which is 10 plus 3 into 3 is 19, correct? 10 plus 2 into 3 is 16, 10 plus 3 is 13, this is 10. Okay, students, so this is what the normal distribution have done. It has equally divided the entire data in these two parts, and the area under this curve, area under this curve would be probability. And it divides the entire series in such a way that both the left hand side and right hand side are always 0.5 and 0.5. That means the probability to get 10 on the next day is 50%. You're getting my point? The probability to get 10 is 50% because of this 0.50. It's 50%. The probability to get 13 will be area under the curve till this 13. All this area from left till right. Till here, whatever is the total area under the curve, which will be, let's say, 0.5 plus some this area. Correct? That will be the total area under 13. That is the probability up to 13. Similarly, probability for 18 will be somewhere here. So area under the curve up to 18, from left to right till 18, whatever is the area under the curve, that is the probability. So hence, Naveen, yes, normal distribution does not mean cumulative probability, but What we need is cumulative probability from normal distribution. Normal distribution can tell you cumulative probability, half probability, every other thing that you want. One tail probability, two tail probability, cumulative probability. Normal distribution can tell you everything, but we have to take always the cumulative probability for the usage in the Black-Scholes model. Now, first of all, the total area under this curve is 1, correct? Because 0.5 plus 0.5, because mean distributes the entire series in the equal manner, correct? That is what the logic is. Hence, it is 0.5 and 0.5. Please remember, this 0.5 is the value of probability, okay? This 0.5 is the value of probability. Now, basically, as I said, that if we have to find for 18, what is the value of probability, correct? What is the probability that next day the price is 18? Next day, the price is 18. For that, what is the probability? So now we have understood the concept, correct? Now how to check it? So we have to find a Z value here. There is a Z score that we have to find. That is how it is find out is the value for which we have to find the probability, which is 18 minus U divided by standard deviation. Okay, students. So what is the probability? Probability that price is 18 is given by 18 minus 4, U is what? 10 divided by standard deviation is what? 3. So 8 by 3, which comes out to be 2.66. So Z score is 2.66. Using the Z score, we have to refer the probability table. See, this is the table. I hope it is getting projected. So this is the table. If you see, it says that standard normal distribution table values represent area to the left of the Z score. From the left to the Z score, this represents, that means this is a cumulative probability, okay? Cumulative probability from left to right. So our answer was 2.66, right? So if you see 2.6 is here. So 2.66 will be this value, 0.99609. So the probability that price is 18 tomorrow is 99.0. What was the percentage? 0.99609, correct? So the probability is 99.609%. We have found the Z score first. Z score, how we have found out? We have taken what is the value for which the probability is required, which is 18. In this case, 18 is lying somewhere here, correct? Here is 18 on this point. So for this 18, what is the Z score coming out to be? Z score is coming out to be minus U divided by standard deviation. Okay, minus 10 divided by 3, hence it comes out to 2.66. We check it from the standard normal distribution table, it comes out 99.609%. That means from left till 18 here, the Z score value is 99.609%. Okay. It can be negative also. Z score can be negative. Now, if let's say we have to find out a probability of 9. What is the probability that tomorrow the price is going to be 9? Minus 1 divided by 3. minus 0.33. Minus 0.33, you have to refer the above table. In this, okay, wait, I'm not able to scroll it. In this, if we go down, there is a minus 0.33 also. Okay. So Z score value of 0.33 will give us the cumulative probability that the next value is going to be now 9. What is the probability that will be given there? Okay. Now, one more thing. Since this is a standard normal distribution table and it divides the data in two halves, 0.5, 0.5. Now, for example, we are somewhere here, correct? Let's say this is the X point where we are there, and area under the curve from, let's say, A till X, and then X till B, for example, correct? This is the endpoint here for B. So A till X is, for example, 0.7, then X to B will be 0.3, because the total area will always be equal to 1. That is what we have already studied, correct? So if we get this area cumulatively from left till Z score, we know that what is the area from Z score till right, correct? Right is till B. Similarly, if the question says, okay, now let me take one more example here. There is another standard normal distribution table. This is the mean value. For example, we have to find a area till here. This is now X. This is A. So A to X and then X to B. For example, now A to X will be less than 0.5, correct? Because it is before the mean. So it will be 0.3. That means here it will be 0.7, because always it will be equal to 1, correct? So this clarifies. Sorry. Now, if that is the case, if A to X is 0.3 and X to B is 0.7, if that is the case, then that means the A to X is 0.30, right? That means 30% probability is that the value will be X, correct? And 70% is the probability that value will not be X. Now, something there here we call as three things. One is one tail, one is two tail, one is cumulative probability. This is one tail probability, two tail probability, and cumulative probability. Now listen very carefully. What is called as one tail probability? This is case 1. This is case 2. In this case, the one tail probability means one tail probability from the right hand side will mean X to B, correct? This is the one tail probability here, correct? If you are given one tail probability, then can you find cumulative probability? Yes. 1 minus one tail probability. Correct? Because one tail means that the tail towards the only one tail, that's all. Two tail is equal to one tail multiplied by 2, that's all. Two tail probability once you are given, then that means one tail multiplied by 2. In this case, what you have to do is two tail, you have to divide by 2, you will come to one tail, and then you have to do this 1 minus one tail. That's all. We will cover that in question also. From there, I will explain it again. but I'm just giving you the logic now since we are covering the normal distribution now. Okay. So there is a concept of one tail, two tail, cumulative. Any combination we can get the data, and while we get the data, we need to see that if it is a one tail, we have to find cumulative probability by using this formula, which is 1 minus one tail. Because as I said, now we have to find out 0.7. We are given 0.3. So we will do 1 minus 0.3. That will give us 0.7. We always need cumulative probability for using in Black-Scholes model, correct? And two tails probability is one tail multiplied by 2. Cumulative, we already know from left till the z-score is called as cumulative probability. Left till z-score. This is called as cumulative probability. And now the last concept on standard normal distribution. So students, for a standard sorry, standard normal distribution. For a standard normal distribution, 99.7% of the values, that means 99.7% area under the curve comes within the range of u minus 3 standard deviation and u plus 3 standard deviation. What I'm trying to say is, this was, let's say, 10, 7, 4, 1, 13, 16, 19. This I'm taking u as 10, standard deviation as 3, correct? In the previous example also. So this is actually u minus 3 times standard deviation, and this is actually u plus 3 times standard deviation. 10 plus 9. 10 minus 9. Okay. So the area between these two under the curve between these two, if we ignore this part, correct? So the area under the curve only for these two is 99 point, how much percentage? 7%. That means the majority of the data falls between u minus 3 standard deviation and u plus 3 standard deviation. The majority of the data, and hence the probability is 99.7% for these two numbers ranges, correct? This is not the cumulative probability, right? This is just the area between two segments. Don't confuse this. This is a probability. This is not a probability on a cumulative basis. Now, can you relate this to something that we have studied already? And while studying that, I told you that I will cover that in the normal distribution. Can any one of you remember where we used this u plus 3 times of standard deviation? I will show you. See this question. U plus 3 times of standard deviation, initial margin. Now the point which I'm trying to give you is, how would stock exchange do this on u plus 3 times of standard deviation? Because the stock exchange knows 99.7% the value will be u plus 3 times of standard deviation. So there is only 0.03% of the chance. Yes, Naveen, it's margin. Very good. 0.03% is the only chance that the price will not be within this range, it will be outside this range, and hence the margin calculation will go for a toss. For bringing the certainty to the margin, we are using the 99.7% certainty. Okay. Value at risk, Naveen, we'll have to see once. Normal distribution table, whether we use it there or not, that we will discuss while we will cover the value at risk. Okay. That also we will cover value at risk in the sessions to come. I hope I am able to bring out logics to the maximum things possible. Okay. And you are able to understand it because of the logic. Don't just grasp it. Okay. So this is what the beauty of standard normal distribution table is. Now coming back to our business. Our business was what? We were reading out the Black-Scholes model formula. Let me again go to the Black-Scholes model formula. Here is the normal distribution. Yeah, here was the formula. Perfect. So I am just putting call premium first of all. This is the call premium that we are talking about. Okay. So the call premium was given by SND1 minus this multiplied by SND2, where we said that. Now students, please note, ND2 is the normal distribution value of D2. That means it's a probability, and normal distribution also gives you a probability only. Correct. And simply this hedge ratio is also represented here in the form of probability only. This ND1 will give you the hedge ratio itself. Okay, the way the formula is structured, it will give you the hedge ratio itself. How many shares per one options. So D1, D2 was this, and this. Where is the ND1 and ND2 that I've mentioned? Just a second. Yeah. Normal distribution value for D1, cumulative probability. We just put it, not one tail, not two tail. It's always cumulative value that we have to take. Cumulative probability. Okay, students. So this is a cumulative probability that we have to take. Now, coming to the put option. This was also one of the question, how to value put option, correct? Now we are covering put option valuation under Black-Scholes model. Okay. So already we have seen the call option valuation. Now put option valuation. Let's go back to our 4 cases that we have studied. Correct. These were the 4 cases. We have already covered Black-Scholes model value of call from here, this case, correct? Value of call BSM is covered from this option, from this case, correct? Now we will pick up this case, case number 4, for valuing put option using Black-Scholes model. Okay, valuing of put option using Black-Scholes model. It's just hardly a very small thing. So in this case for what we said, what we are going to do is that again Mr. X is the person, correct? So first of all, he is going to sell a put option. And for selling a put option, he needs to sell the shares now because he has to invest the strike price now, correct? Just a second. Let's go to the case number 4 and see once. So short put option, and we will invest the present value of strike price by shorting the shares in the market, correct? So I am saying I'm just going one step down. So sell put option and sell shares in the market, correct? In spot market. This is also one of the response that we get, correct? Because we have to short sell the shares in the market. From that only we are going to invest the money as a present value of strike price, correct? Okay, so these are the two trails. Now we can apply the same logics to this formula as well. I'm not going into that deep discussion, correct? But I'm just writing the formula itself here. So first is that we are selling a put option. While selling a put option, you have to, you will get, sorry, we are selling the right to sell. If we are selling the right to sell, that means if that right is exercised, there will be something that will be sold to us and we have to pay the price for that, correct? So this will involve the cash outflow of strike price, correct? And this will involve the cash inflow currently, because once you short sell the shares in spot market, there will be a cash inflow of spot price. Once the option is exercised, the right to sell is exercised, the person will sell you, we will purchase the shares, and whatever short sold we have done in the spot market, we will give the shares back. Okay, we will give the shares back. So basically what we are going to do is, see, I'll tell you the exact chain here. For case number 4, this is the chain. Borrow an asset. Okay, that means one asset you have to borrow. Short sell one asset. Here one asset is the equity share itself. Okay, once you short sell the equity share, you invest the present value of strike price equivalent in some security which gives you the R percentage per annum rate of interest. This is the inflow, this is the initial things. Then what will happen? Redeem present value of strike price on maturity. This you redeem it. After redeeming it, you go and purchase one asset through the option, because you have sold the right to sell. From that option you will have to purchase, because you're writing it, correct? After purchasing it, that asset, you hand over the asset from whom you borrowed. Okay, you don't have to remember this entire chain, but I'm saying that's how the hedging strategy will work, correct? And from this we can just carry out the formula. Okay, value of put is equal to, I'm just straight away going to the formula now, x raised to the power e minus rt, present value of strike price, multiplied by n minus d1, sorry, n minus d2 here, minus spot price multiplied by n minus d1. This is the formula. See, in case of a put, if the spot price is going down, then only you will get a benefit. Correct? That's why we have put first of all the spot price here, not in the beginning of the equation. Correct? In case of a call option, you will get a benefit if spot price is higher than the strike price. But in case of a put, the benefit will be when the spot price is lower. That is why we have put the spot price after this present value of strike price. Correct, students? Then this is the present value of strike price that we are going to invest. Basically, this is all is cash outflow. This is cash inflow. Correct? Cash inflow. Why? Because you will short sell, you will get the cash. For short selling, you have already borrowed the asset. Once you purchase the asset back through this option, you will give the asset back to the borrower. Simple. Okay, this is the present value of strike price that is getting invested. Now, what would be this? Can anyone tell me? N minus D2 is what? N minus D2 is what? See, if N D2 is the probability, then definitely N minus D2 will always be the will also be the probability, correct? But if N positive D2 is the probability that price would go up from strike price, correct? This is that probability. N minus D2 would be that probability that price would go down from strike price. So below strike price, what is the probability that the price will go down? This is what is N minus D2 is. Because you will earn in a put option if the price is going down from the strike price. That is what N minus D2 is, correct? So I'm just referring to this N minus D2. S is simply the spot price at which you will do the selling today. Minus D1 is again the hedge ratio for selling purposes. For selling, what would be the hedge ratio? In the valuation of call option, we have seen the hedge ratio from the purchasing purposes. Okay, students, this is the valuation of a put, valuation of a put option. So probability that price would go down from strike price is N minus D2. N plus D2 is the probability that price will go up, minus D2 is the probability will go down. Simple. So with this, all the concepts for this session comes to an end. We have to attempt the question, but we will not be able to finish it within time. Hence, we will cover this question along with the put call parity theory in the next session and some of the leftover things. Till now, if anyone have any query, please feel free to ask. I'm not covering the question now because it will not get completed in some time. It will take good enough of time because only one question on Black-Scholes model and second question on put call parity theory. Those are the two questions that are left. I hope so. Yes. Yes, that's all. So students, please do ask any questions if you have. Otherwise, we can just see once the valuation of call option and put option again, and then we can wrap it up the today's session. Okay, so what we discussed is, I'm not going to the formula now. I'm just giving you the glimpse here is that you have to do as a hedger some kind of a activity. While doing that activity, you invest the present value of strike price and you purchase the equity share for valuation of a call option, correct? Which is here, the case number 2 that is there, correct? Because you are selling the call option here. From that perspective, whatever is the cash outflow minus cash inflow, that has to be the total call premium, correct? And for that, we have also studied that what is the normal distribution role that it have here. Normal distribution is just a model that gives you a probability as an output, taking the standard deviation and mean as input. Okay, this is the normal distribution, and using that we also studied the logic on this u plus 3 times of the standard deviation. Input, we have used the case number 4, where we are saying that currently you will have to short sell a stock, invest the present value of strike price in the market to get the proceeds so that you can buy the stock if the option is exercised. Simple. And the spot price, hedge ratio, and the probability. So all these things comes into the play while you want to solve the question. We will see in the next class the question solving is very easy. You have to just apply the formula and solve the questions. That's all. So no more questions, students, that we can just take it up for the today's session. Okay, Namita, let me take your question. Question number 2 in reverse cash and carry. Okay, so Namita, reverse cash and carry is that question number 2. Let me quickly go to the question number 2. This is the question number 2, right? Question number 2, we have seen there is one thing called as cash and carry arbitrage, and there is a reverse cash and carry arbitrage, correct? You don't have to remember these names. I just told you from the technical point of view. So reverse cash and carry is what? Long forward, borrow equity share, short sell equity share, and lend the money at R percentage. Because here also you are short selling, correct? The equity share after borrowing the equity share. The same case that we have just seen now. So it is reverse cash and carry. But if you, this is the cash and carry, right? Forward is overpriced, short sell forward, borrow money, and long one spot. This is called as cash and carry, correct? Because you have borrowed the cash and then you are carrying the asset. Simple. Namita, your question is also not complete. It's just coming in reverse cash. That's all. So I have explained the reverse cash again. Question number 7, we have taken percentage change in future price. It is of market now, so how it will be applied on futures. Okay. So Namita, in question number 7, the change of 2% is for the market only, but the index are also of market index. The index is also a market index. So if there is a 2% change in market, the same impact will be given to the 2% change in the futures. Okay, that's why we have taken it to the same. Because in question number 7, the futures are index futures. That is the market index futures. Okay, students. So with this, let's end today's session. Okay, Namita is asking one more question. Question 10, why we are selling 30% of all 3 companies? No, Namita. So Namita, in question number 10, 30% is the total reduction in all the proportionate companies to make it to the some beta of 0.91, if I remember. For that to be made, or whatever is that value, for that to be made, from all the companies, you will have to proportionately reduce. You try testing this solution by reducing some different proportion in different companies, you will get a different answer, Namita. Okay? Because for all the weighted average beta, we have to reduce it to certain extent. Hence, all the companies will have to reduce it to certain extent. Okay. So let's end today's session here, students, and please do revise the questions and the concepts before we end the derivatives in our next session. Okay, so just stay safe, do the revision, and let's catch up in the next session now. Okay, thank you.